Hi again. So far in this DVD series, we've talked about buying calls as a way to speculate on the upside of stocks. We've talked about selling calls covered against shares that you own in order to generate some income. We've talked about selling calls uncovered as a risky play. We've talked about buying puts, speculate on the downside of stocks, and we talked about buying puts to hedge a position that you have currently in your portfolio. But now we've saved the best for last. If you only do one option trade, if you're brand new at options and you want something that is almost lock solid, downright easiest thing to do in order to make money in the options market, this is what we're going to talk about today. Selling put options. Selling put options, if you remember way back to when we first talked about the four basic strategies, this is the fourth one. Selling put options, you receive premium, and you have an obligation to buy the stock. Think of it this way. Think about if there's a stock that you'd really like to own, but you'd like to own it a little bit cheaper than where it's trading right now. Think about contracting to do that, to buy it at a little bit cheaper price, and think about getting paid to just agree to buy that stock at the cheaper price. You know, I'm not talking about buying the stock, having to wait for it to go up. I'm talking about simply agreeing to buy the stock at a lower price than where it is right now, and somebody pays you to do that. It doesn't get much easier than that. I mean, you can think about it, if you go shopping at all, you go into a department store, you find a nice tie that you like. You take the tie over to the cashier and say, listen, I'd love to buy this tie, but I'd like to buy it 10, maybe 20% cheaper. So hang on to it and let me know when it's 10 or 20% cheaper. And she takes the tie from you, she reaches into the cash drawer and pulls out a $20 bill and gives it to you. And you go away. You got 20 bucks in your pocket, and you've agreed to buy that tie when it's on sale 20% cheaper. That's what selling puts does, and that's what makes it so easy to make money when you're selling puts. Now, I'll give you a couple of basic ideas to lead you into this. First of all, you don't want to sell puts on stocks that you don't want to own. You know, if you don't like Chipotle Mexican Grill at this price, you wouldn't like it at any price, you don't want to sell puts against it. You want to sell puts on stocks that you like the idea of owning, stocks that you've been waiting, maybe waiting months, maybe waiting years to get to the right price for you to feel comfortable buying the stock. Those are the types of stocks that you sell puts against. I'll give you an example. We'll go all the way back to the first example we used with Intel. And let's say, once again, Intel is trading at about $20 a share. Now, if you like Intel at 20, you could buy it at 20. But why not agree to buy it at something a little bit less? Get it on sale. How about we agree to buy Intel at 19? So what we'll do is we'll sell one Intel May 19 put, currently going for about 70 cents. Let me explain what's going on here. Intel is currently trading at $20 a share. You like the idea of owning the stock, but boy, you'd sure like to get it a little bit cheaper. Now, you could wait until it gets cheaper and then go ahead and buy it, but you don't make any money doing that. Here, you're going to be able to make money without having to wait for the stock to get cheaper. What we've done here is we've given somebody else the right to sell to us their shares of Intel anytime between now and option expiration day in May at $19 a share. And for that, we've collected 70 cents a share. So we're going to get $70 up front for just agreeing to buy Intel at 19. Now think about this. Intel's at 20. We're just agreeing to buy it $1 cheaper, and they're paying us for that. It doesn't get much easier than that. Now let's say Intel never goes anywhere, never drops, just goes up in price. Well, come option expiration day in May, that option expires worthless. We've collected our $70 up front. We have no further obligation. Nobody's going to sell the stock to us at $19 a share if Intel is trading above that. So we're not obligated to do anything. The option expires worthless, and we can go ahead and sell the next month. Sell in June, sell in July, sell in August, and just keep going, keep collecting that income. If Intel drops, we've agreed to buy it at $19 a share. So if Intel drops below 19, yeah, we're going to buy it at $19 a share. We're obligated to do that. That's what we were paid for in the first place. But we were okay with that anyway. We like the idea of buying Intel. We like the idea of buying it at $19 a share. If it got there, we'd have bought it anyway. So why not get paid just to agree to do that? And then we'll actually own Intel at $19 a share, and everything that we wanted to buy it for, we have in place to begin with. All right? Take another example. Walmart. Walmart's been a stock that really hasn't gone anywhere for years. Walmart's currently trading around $55 a share. Lots of folks like Walmart. Lots of folks think it's a great retail stock to own. It's certainly the largest retail establishment in the world. It'd be wonderful to be able to buy it a little bit cheaper. Gosh, if it would just go on sale once in a while. So why not? I don't know. I'm thinking maybe $50 a share makes more sense. So why not sell one Walmart August 50 put? And current price on that is around $2. So we're basically agreeing to buy 100 shares of Walmart anytime between now and August expiration at $50 a share. And for that, we're getting paid $2. Think about it. Again, stock's trading at 55. We're not buying the stock. We want to buy it cheaper. And just by agreeing to buy it cheaper at a price that we would be willing to pay for the stock anyway, somebody's going to pay us $200. Do you understand the concept with that? That is phenomenal. You can do that day in, day out on stocks that you want to own and clean up. Seriously, if you're only going to do one thing in the options world, this is what you need to do. You need to sell puts on stocks that you want to own anyway. Now, most people don't do this. I don't know why. Maybe it seems complex, maybe it seems a little bit difficult, but it's no more difficult than taking that tie off the stand at the rack over to the cashier and say, tell me when this is 10% cheaper and pay me now for it. That's all it is. Now, I know even by having this on the DVD and talking about it, I know most people still aren't going to do this, which is what makes this such a lucrative thing. So few people are competing with you for it. But right now, this is a situation that exists with Walmart. You can get this real cash right now. You could get the Intel example real cash right now. Any stock that you're interested in owning that's optionable, you have the ability to go ahead and sell, put options on it, agree to buy it at a lower price, get paid right now to do that. You never have to actually put up the money until the stock is put to you, assigned to you, at a price that you agreed to purchase the stock for anyway. It doesn't get much easier than that in terms of option trading. I'll give you another example. This is one that I think makes sense. Again, for anybody who's looking to buy stocks cheaper. Right now you have a situation in the stock market. The market might have moved up a little bit. Things have gotten a little out of hand. Stocks are extended to the upside. And a lot of folks haven't been participating. You know, they've been nervous. Ever since the market fell apart a couple of years ago, they've been nervous about putting money into the market. Now people are feeling a little more comfortable about things, but prices are extended. So they're a little concerned that, hey, prices may come back down. So rather than buying something like Apple at $350 a share, gosh, it'd be nice if it would come back a little bit. So why not commit to buying Apple at $300 a share? And right now in the market, you can sell one Apple October 300 put for $12. In other words, by agreeing to buy 100 shares of Apple at $300 a share anytime between now and option expiration day in October, they'll pay you $1,200. Apple's at $350. The stock's got to drop 20% in order for you to be obligated to buy the stock at $300. That's a pretty good deal. They'll pay you right now simply for agreeing to buy Apple at $300 a share. Now, I'm not saying this is something you should do, but if you're interested in buying Apple and you think it might be a little pricey right now, you're not making any money by sitting on the sidelines. But if you think Apple's a great buy at $300 a share, and for sure, 100%, absolutely, I'd buy it at $300, why not get paid today by simply agreeing to do that? If it gets to $300, you'll get to buy the stock. If it never gets to $300, you made $1,200 and go on with your life. Do it again, do it again, do it again. You do it all the time and make as much money as you like doing that. This is the simplest, easiest way to make money in the option market. I wish more people would do it. It's phenomenally profitable, and you have terrific opportunity to pick up stocks that you want to own at prices that are significantly lower than where they are right now. So let's take one more example, and this time we're going to use an example of stocks that I actually enjoy trading. I love to trade the gold sector. Gold stocks are phenomenally volatile. They'll often move 5, 10, 15% in a matter of a couple of days, and they're wonderful trading vehicles. And one of the best strategies you can use with those sorts of trading vehicles is what we're talking about here, selling uncovered puts, where you're obligating yourself to buy the stock at a lower price than where it is currently. I'll give you an example that exists in the market right now. Newmont Mining symbol is NEM, nation's largest gold mining company. It's currently trading around $53 a share. Now that's down from a high about 10 points higher than that. I think it hit a high of about 63 not too long ago. So it's already come down. It's not cheap enough to where I think it represents a huge bargain. It's a pretty decent bargain, but it's not a huge bargain. I wouldn't mind buying it at 50 though. Of course, it may not get to 50, which means I may not have a chance to buy it. It may go up from here. I won't make any money. But why not, if I'm willing to buy it at 50 today, why not obligate myself to buy it at 50 and get paid for that obligation? So for example, I can sell one Newmont Mining August 50 put for about 4 points. So I'm obligating myself to buy 100 shares of Newmont anytime between now and option expiration day in August at $50 a share. And for that obligation, I am collecting today $400. Again, think about this. The stock's at 53. I'm agreeing to buy it at 50. So if it's below 50 on option expiration, I'm going to have to buy it at 50. So again, this is a strategy you use for stocks that you want to own anyway at the price you want to own them at. So I'm going to wind up buying the stock at 50 if it's trading below 50 on option expiration. But I get $400 today just for agreeing to do that. I can make $400. I put up no capital. Stock's at 53, and I'm simply saying, hey, if it ever goes on sale, gets down to this price, I'm willing to buy it. I know this sounds too good to be true. I know it's, oh gosh, there's got to be a catch. The way I'm describing it here, there isn't a catch. You obligate yourself to buy stocks that you want to buy anyway at the prices you're willing to pay for it, and you get paid to do it. Now, where people make mistakes in this strategy, where people do stupid things in this strategy, is they over-leverage it again. I'm willing to buy 100 shares of Newmont, and if you normally trade in 100 share increments, you sell one option. If you normally trade in 500 share increments, you can sell 5 options and obligate yourself to buy 500 shares. But you don't, if you normally trade in 100 share increments, you don't sell 10 of these. You don't sell 20 of them. I know it sounds great, geez, it's free money. Make $400 for each contract we sell, so why not sell 10? Well, because you're obligating yourself at that point to buy 1,000 shares at $50 a share. It's a big difference. If you normally trade $5,000 at a time, there's a big difference to trade $50,000. All right? So don't over-leverage the trade. Don't get into a situation where an adverse move in the market is going to collapse your account. Yes, I like the idea of buying Newmont at 50. I think, gosh, if it ever gets down there, I want to buy it anyway. But you don't want to have everything you have in Newmont Mining. So keep your position accordingly. The other thing to know a little bit about where you don't want to make the mistakes is you don't want to sell uncovered puts on stocks you don't want to own. You know, sometimes the premiums, what they'll pay you to sell that option, are very large, and they're usually very large on companies that are extremely volatile. If you're not into volatile stocks, if you don't like the idea of owning volatile stocks, then don't sell uncovered puts on those volatile stocks. Because you will, there's a good chance you will wind up owning the shares. Make sure it's stock that you want to own. If you don't like fly-by-night airlines, don't sell uncovered puts on fly-by-night airlines. There's no such thing as fly-by-night airlines, but you get my point. Okay? Now let's spend a little bit of time, come off of this a little bit, and talk about expiration dates, talk about strike prices, and talk about premiums. There's some basics about general option trading that's important to understand. You can buy options any month of the year. The Options Clearing Corporation is the entity that basically creates the strike prices, creates the different options that are available. Bottom line is, though, if there's a market for options, those options will exist. For example, you can buy Newmont Mining options for every month. You can buy January, February, March, April, May, all the way through, going out for 3 years. You can buy 3-year options on Newmont Mining because it's an active enough stock, active enough option market. No problem at all getting people interested in trading that. Not every stock is like that. If there was a fly-by-night airlines, who knows? Maybe they only have options every 3 months. Maybe people only like the idea of buying the January, March, August series of options. So if they don't exist on a particular given month, it's probably because they're not that liquid. They're not liquid enough to have an extra series out there. If there's a demand for an option to exist, it will exist. So if there's a lot of demand for a particular stock's options, they'll have every single month. If there's not much demand for it, then they'll break it up. so there's not so many options in existence, and you can concentrate that demand on months that we can create a little more volume. Because the worst thing that can happen in an option situation is where volume dries up, where you own an option, but you can't get out of it because there's not enough folks willing to buy it. Or you're looking to buy an option, but you can't get a decent price because there's not enough folks willing to sell it. Option market and the stock market are very, very similar. A lot of it, the pricing is based on supply and demand. The more people willing to trade a stock, the more liquid that stock is, the better the pricing. Same thing in the option market. The more people willing to trade an option, the better the pricing, the more competitive it is. It's a lot better to have thousands and thousands of people fighting over different option contracts than it is to have 2 people fighting over the price of an option contract. Same thing goes for strike prices. You know, stocks that are fairly expensive, you look at stocks like Chipotle Mexican Grill, you look at Apple, look at IBM, look at Google. Google trading up around $600 a share. It has strike prices basically every 10 points. So you can buy the right to buy Google at 60, you can buy the right, or at 600, you can buy the right to sell Google at 600. Same thing at 610, same thing at 620, same thing at 630. If there's enough demand for it to go in between, 605, 615, 625, then the Options Clearing Corporation will create options to satisfy that need. But if you have a stock like Corinthian Colleges, COCO, trading around $5 a share, there's no need to have a $600 strike price for COCO. Nobody's going to buy that. Just as there's no need to have a $5 strike price for Google. Nobody's going to be interested in trading that. So the most active options tend to be right around the current price of the stock. And what we've done in this DVD series so far is we've shown you situations where options are basically concentrated near the current price of the stock, because those tend to be the most active. If Newmont Mining is trading around $50 a share, you're going to see the most liquidity in the options with a strike price around $50 a share. Stock trading at $60 a share, most liquidity is going to be in the options trading at 60. That doesn't mean you have to trade that. There are other choices available. You can trade the 55s, the 50s, the 65s, the 70s, whatever else exists. And as I mentioned before, in a later DVD series, we'll talk about which strategies work most appropriate for that. But really what I'd like to get through in today's session is to look at everything that we've talked about so far. We talked about buying calls and when and why you would speculate on the buy side. We've talked about selling calls covered and how that's used to generate income. We've talked about selling calls uncovered and the particular risks associated with that. We've talked about buying puts to speculate on the downside. We talked about buying puts to hedge a portfolio position. And today we talked about selling uncovered puts as a way of buying a stock at a cheaper price and getting paid today to do that. All of these strategies work out really well. All of them will be useful at some point in the future for you. There are times where buying calls make more sense than selling calls, times where buying puts make more sense than selling puts, times when selling puts make more sense than buying puts. All of it depends on current market conditions. And one of the things that you can use to gauge current market conditions is something called the volatility index. Traders, we call it the VIX. Volatility index. This basically tells you, well, most traders look at it as a fear gauge. That's the easiest way to explain it. It's the level of fear in the marketplace, and it moves around constantly. Right now, the VIX is trading roughly around 20. That doesn't mean $20. It's not something you can buy. It's simply an index. It's a gauge. It's ranged, in my career, it's ranged from as low as 7 to as high as 120 during the market crash in 1987. It measures the level of fear in the marketplace. Technically, it measures the volatility premium that folks are willing to pay for S&P 100 options. Go figure that one out. It really just measures the VIX. The higher the VIX, the higher the level of fear in the marketplace. The lower the VIX, the lower the level of fear. VIX is a contrary indicator. This is important to understand. Contrary indicator means whatever it's saying, it's probably better to do the other thing. So if everybody's afraid, if the VIX is trading around 30, 40, 50, a lot of fear in the marketplace, a lot of folks selling, it's probably a good idea to start buying. It's a contrary indicator. If the VIX is low, it's trading around 15, 16, 17. Everybody's happy. Everybody's complacent. Odds are pretty good. The market's had a good run in order to get the VIX down to that level. Everybody's feeling pretty comfortable and confident about stock prices. That's where you might look at hedging a little bit, maybe betting a little bit on the downside. Now, since the volatility index is basically a function of the premium that folks are willing to pay for options, it gives you an idea as to how expensive or how cheap options are as well. Now, understand this. When the VIX is low, options are cheap. The best side of the trade to be on when the VIX is low is you want to be buying. So a low VIX, better to buy calls, better to buy puts. If the VIX is high, that's the optimum time to be selling options. A high VIX, something 30, 40, 50, well, you want to be selling puts, selling calls. That's when you generate the most income, by the way, from selling covered calls. Absolute best time in the world to buy puts, VIX is cheap. Absolute best time in the world to sell puts, VIX is expensive. And I'll give you a couple of examples. And if I start shaking and trembling and sweating, you know the story. 1987, October 16th, 1987. This is the Friday before the Monday crash. I was loaded to the gills with puts. Back in August, the VIX got down somewhere around 8, 9. Puts were dirt cheap. A lot of folks couldn't understand what was holding the market up because the market had just been on a gangbuster run the whole year, and a lot of us were bearish on it, but nobody could really understand what was keeping the market up. It just kept moving. VIX got super cheap, and all of a sudden speculating on the downside made a whole lot of sense. So I bought a bunch of puts. I bought puts on IBM, I bought puts on the S&P 100, I bought puts on 5, 6 different positions, and I had a pretty good portfolio of puts set up there. So when the market started to fall, roughly around mid-September, profits started to come in, feeling pretty good about things. But I wasn't going to sell my options, my put options, until I thought they were expensive. I bought them cheap. I knew I bought them cheap. I was going to wait until they were expensive before I sold them. October 16th, 1987, the stock market, this is the Dow Jones Industrial Average, fell a little over 150 points. And I think that was the most up to that point. It was one of the first days that the industrials had fallen over 100 points. Again, we're talking about the industrial average, which was trading, around 2,800 at the time. So 100 points, pretty large percentage move, especially relative to what we're talking about today. And all of the put options I had inflated tremendously. The volatility index spiked as high as 60, I think, on that day. And remember, I bought the put options when the volatility index was down around 8. So not only did I get the benefit of buying put options and watching those stocks fall, but the volatility factor of those put options inflated because the VIX inflated. So folks were willing to pay much more for the option premium than what would have been justified previously. So it was a pretty good deal. We got profits on both sides, from the stocks falling and also from the VIX increasing. And the VIX was up around 60, I think, at the point. I thought, well, that's about as high as I recall ever seeing it. So I thought it was a good time to sell. So I took all the puts that I had, sold them all. Made a very nice profit. I'm not hurting over that. That was a great day. Went home for the weekend. And of course, you all know what happened the next day, October 19th, 1987. The stock market crashed. Dow Industrial Average dropped 500 points. And all of these puts that I sold with the VIX at 60, well, the VIX shot up over 100. They all quintupled from that point. I had made a nice little profit, but had I held on one day, just one little day, it was enough to retire on. So you can never time things perfectly, but my point to all that is you want to buy options when the VIX is low, and you want to sell them when the VIX is high. Had I held on the next day, had I been smart enough at that time to start selling put options when the market had crashed, boy, if you can get paid to agree to buy stocks a whole lot cheaper than where they are currently, and you can get paid handsomely because the VIX is trading up around 100, you'd clean up on something like that. So a couple of points to kick off here. Volatility index, very good clues to telling you where we're at in the particular market cycle, whether it's a good time to buy options or a good time to sell. You buy options when the VIX is low, you sell options when the VIX is high. If you can get in low, great. Hold on a little bit, wait until the VIX is high and be willing to exit that trade. The VIX is a contrary indicator. So if everybody is fearful of the market, that's the best time to get in. The VIX is high, that's when you sell the options. VIX is low, everybody's comfortable in the market. That's usually a pretty good time to get out, or at least look at buying options to hedge or speculate a little bit. So we've covered a lot in this DVD series. everything from simple strategies of buying calls, buying puts and selling puts, and some of the other things that go around that. And on the next DVD series, we'll take a look at specific stock setups. We'll look at charts, chart patterns, and we'll see what options are best to use to take advantage of those patterns to maximize your profit potential with that. For today, we covered an awful lot. We covered the 4 basic option trading strategies. We covered risk-reward parameters. We covered the volatility index. A lot of stuff to go over in one shot. If you have any questions or any concerns about any of this, take a look at the workbook. Go through that. Review the DVDs. Play this back and forward multiple times. Do a little bit of paper trading. Take a look at the option market and get a feel for it. Bottom line is, there's no rush to do all this stuff. You can do one at a time. You can do all 4, whatever it is that you're comfortable with. Bottom line is, option trading is a fabulous tool to reduce risk and increase the return of your portfolio, and you ought to be taking advantage of it. So far, if I had one thing to recommend to you, if you can only do one at a time, I'd say today's DVD, Selling Uncovered Puts, probably the best way to start off. And we'll see you on the next series.